Time now for today's strategy session. The Federal Reserve kicking off its rate cutting cycle last month. And traders, they're still optimistic that the rate cutting cycle is going to continue. More than 90% of traders are betting on a 25 basis point cut at the Fed's next meeting. But are investors getting ahead of themselves on the prospect for additional easing this year? Joining us now, we want to bring in Seema Shah, Principal Asset Management Chief Global Strategist. Seema, it's great to have you back. So I think this is the big debate, or I know that this is the big debate happening on the street right now, is what the Fed is going to do next, especially on the heels of that hotter than expected jobs print that we saw last month that started, I guess, to enter the conversation or start the conversation about maybe the Fed is going to pause at its next meeting. What do you think?
Thanks for having me on. Look, you're right. It is a big debate. I think for us, it's actually fairly clear, though. That report, the jobs report, was very strong. But just like the July numbers seemed like a bit of a brain teaser in terms of how low it was, you could have seen the same thing with the latest one. So I think the data is very, very volatile. There's a lot of seasonality, weather-related issues, which are playing through across all the labor market data. So at the moment, it's really important not to take any single number and use that to kind of extrapolate where the Fed is going to go. What we're looking at, we're seeing that there is a slowdown in labor demand, and that really comes through across pretty much all the data that you look at if you're looking at it over a kind of a 3-month trend line. But nothing too concerning. On top of that, which is I think is really important, is that the Fed has been very clear in the previous months that they don't want to do a stop-start cycle. Their intention is to do easing. We do know that the US economy is slowing. It's not slowing too much. To us, that means that there's still a process of normalization taking away some of that restrictiveness. And so that's a 25 basis point cut in November, another one in December. I think where the uncertainty starts to come in is probably around the middle of next year, when we have to wonder, what is that neutral rate? How low are they actually going to go?
And so as the Fed has kicked off their cutting and their easing cycle, one of the things that you're also focusing on is the amount of cash that's sitting in money market accounts and sitting on the sidelines effectively. How much of that and how rapidly do you anticipate that could flow back in to equities or other assets?
Yeah, so there's about 6.6 trillion sitting there in money market funds. Now, not all of it is going to move, and it's actually very difficult to figure out the specific size or the timing. But we know that some of the stuff that's sitting in money market funds is simply what people are going to use as their safety. I guess their assets that are going to sit in safe places. So not all of it is going to move. But at the margin, for people who had moved some of their funds into that space because they were earning high interest rates, as interest rates continue to come down over the coming months, there will be that growing urgency from investors to start thinking about where else they can deploy it. Ideally, they would have done it a few months ago, especially when you consider how far equity markets have already moved and where credit spreads have already tightened to. But as we look out over the coming months, because we're expecting a soft landing, continued rate cuts, that is a sweet spot for risk assets. We think there's continued upside for equities, probably not as much as you saw in 2023 or certainly early in 2024, but there is at least some further upside to come. And even in credit markets, in this environment, you probably want to be extending duration, getting at least a bit of that pickup that you're going to get from credit rather than staying in cash.
Seema, what do you think that upside, or what is going to drive that upside? Is it all about earnings?
The earnings is going to be a really key story. When we look at equity markets, so much of it has to be driven by fundamentals. In a soft landing environment where you see the economy slowing, but it's still solid growth, that should still be fairly good news for earnings. And the equity market typically follows the earnings story very, very closely. So for us, that means continued gains. Probably the concern for investors right now is that the bits of the market that have really driven, for example, the S&P 500 higher, have been that Magnificent Seven, where valuations are looking quite lofty. But in a growth environment, you should see that positive story broadening out to other sectors. And we're already seeing that come through in the earnings. I mean, even in these early days of the current earnings season, you can see that financials are doing pretty well, industrials increasingly. So that's where we're looking to maybe see some of those additional gains over the coming months and quarters.
And then just additionally here, as we think about some of the pullback that we were talking about at the top of today's show with regard to the semiconductor stocks and $420 billion in market cap essentially combined being wiped off the table, what type of dip buying are you anticipating we might see take place when we have pullbacks like that?
I think it makes sense for there to be some dip buying. I mean, from our perspective, it still makes sense to have these overweight to these tech and tech associated stocks because we're looking at it from a secular perspective, believing that they will continue to deliver earnings over the long term. So, a correction, it depends, of course, what size, but a correction probably would be time to increase your exposure. But we have to recognize that there are regulatory concerns starting to crop up, tariff concerns starting to crop up. So maybe we have to see how the story develops. But certainly it could reduce the potential for some of these stocks over the coming years. So that is something that does need to be taken into consideration. And another reason why investors should maybe start to consider some other sectors in the market which maybe haven't had such a wonderful run up over the last 2 years.
Which sectors would those be?
So increasingly, look, again, if it's a soft landing economy, you'd expect to have some upside for some of the cyclicals. In particular, we do like financials and we do like industrials in this space.
Seema Shah of Principal Asset Management, thank you so much for taking the time here with us today, Seema.
Thanks.